surprises today from the Bank of Canada with no interest rate change. But with the U.S. Federal Reserve set to hike rates, what can we expect ahead? We dive into the details with Andrew Kelvin, Senior Rates Strategist at TD Securities. Welcome, Andrew.
Thank you.
Well, let's start off with U.S. rates, obviously set to move higher. Bank of Canada, not so much. Are there any risks posed by that scenario?
I don't think there's risks. I think it's actually somewhat advantageous. The difference between U.S. rates and Canadian rates is a primary driver for the Canadian dollar. So as the Federal Reserve lifts rates and the Bank of Canada doesn't, it should cause the Canadian dollar to depreciate, which will help our exporters. So
overall positive, except if you're trying to go to the U.S. and buy something.
But it will help internal tourism. If going to the U.S. on a holiday becomes 30% more expensive, as it has relative to 3 or 4 years ago, suddenly doing a vacation in Prince Edward Island, for example, seems a lot more attractive.
It does.
I guess where there would be risks is that Canadian mortgage rates are tied quite closely to bond yields in Canada, which are tied quite closely to bond yields in the U.S. So we could see financial conditions tighten somewhat when the Federal Reserve hikes, but on net, I think it's probably advantageous for the Canadian economy.
So how long are we going to wait in Canada then?
How long are we going to wait? Could be 18 months. We don't expect to see the Bank of Canada lift interest rates until mid-2017.
So what's going on in the underlying? What's your outlook for like oil and gas and the export sector?
Well, in oil and gas, there's still an issue of significant global oversupply, which should keep oil prices quite depressed for at least the next 2 to 3 quarters, and even then we're only likely to see modest increases. So from the commodity sector, there still isn't a lot of incentive to invest in new projects, which is obviously negative for employment and income there. Fortunately, with the Canadian dollar weakening to the extent that it has, we have started to see a pretty healthy pickup in exports. So the hope from both ourselves and the Bank of Canada is that with a stronger U.S. economy and a weaker Canadian dollar, exporters can help pick up some of the slack from the commodity sector.
So when we look at the Bank of Canada, they come out with their forecast.
Yep.
How well are they tracking to that, do you think?
Recently, it's been reasonably accurate.
Okay.
For the third quarter of the year, the Bank of Canada had been looking for 2.5% growth. Actual growth in the third quarter was at a 2.3% pace, which is a negligible difference, really. Going into the fourth quarter, the bank is looking for a deceleration to about 1.5%. Right now, we think the risks there are skewed to maybe perhaps a little bit lower a growth rate, but it's still qualitatively quite similar to what they're expecting. They said in their communique today that the economy has evolved in line with their forecast, so I think they're quite comfortable with where the economy is today.
All right. And now, so when Canada moves, probably pretty slow, or do you think we're going to catch up pretty quick to wherever the U.S. is at that time?
It will be reasonably slow. We're probably not going to see a return to the sort of high interest rates we saw. I mean, not even going back to, say, the 1980s, but even what we saw prior to the downturn, interest rates at 4 and 5% from the central banks are probably not going to be the peak of the cycle this time. So with a lower target that they need to hit going forward to get back to neutral, they can afford to be very gradual in their move higher.
So like years?
It could be 2 or 3 years.
Really? Wow. Okay. And in the U.S., similar, or what?
Something similar in the U.S. We expect to see only 4 interest rate hikes within the next 15 months in the U.S.
Okay. So I guess good for people that hold mortgages.
Not as good as no hike would be, I suppose.
Yeah, exactly. What does this mean for the loonie then?
The loonie is likely to depreciate versus the U.S. dollar. We think we could see the Canadian dollar, it's at 75 cents today roughly. We think we could see it at about 71 cents by the first quarter of 2016.
Wow, so that's pretty low, and then staying there for a while, or?
That will probably be as low as it gets. We think we'll probably see it pull back reasonably quickly back to sort of 73, 75 cents. Get into 2017, 2018, we're probably thinking an 84, 85 cent dollar.
All right, not too bad then, I guess. We'll wait for that movement upwards. Thank you very much, Andrew.
Thank you.
I've been joined by Andrew Kelvin, Senior Rates Strategist at TD Securities. I'm MaryAnn. Thanks for watching.